What's up, everybody? It's Stas here. So this is part 2 of how to pick winning stocks in the stock market. And if you guys missed part 1, I'll link that right down below at the top of the description box. And this is a series that I'm doing to pretty much show you all how I pick stocks in the stock market, how I go about it. And by no means is this the only way you can do it, the right way to do it. This is just my way of doing it. So today we're going to be talking more about financial statements, diving a little bit deeper into the businesses themselves, because look, like I mentioned last week, there are 3 points that I look at when it comes to a business, and this typically takes me about 10, 15, 20 minutes to do. And if it passes these 3 points, the 3 checklist points, whatever you want to call it, then I dive deeper into the business. I look under the hood of the business, so to say, and I look deeper into the financials and more of the nitty-gritty. And again, that's what we're going to talk about today. But first, like I said last week, just to recap quickly, number 1, I must see the vision of the company. Number 2, I have to understand the business fully. It has to be in my circle of competence. And number 3, the business must have a strong moat. It has to have a very, very, very strong competitive advantage. And that's pretty much the 3 things that right off the bat I look for in a business. It takes me about 10 minutes. And if it doesn't pass those 3 checkpoints, again, I don't even look into the financials. So let's just go over now what I personally do when it comes to financials, what I look for, and we'll run down the financial statements, the income statement, the cash flow, statement of cash flow, and of course the balance sheet. So let's do that now. Alrighty guys, so what you see right here is quickfs.net, and no, I am not sponsored by them. This is actually a website, a company, whatever you want to call it, that I've been using for probably over a year and a half, 2 years now. And this is the best and free. It's free. It's free. This is the best way. And I'm putting you guys up on some game right now. This is the best way that you can look at financial statements for free and 10 years of data. That's the important thing, because you can look at Yahoo Finance, you can look at all these other, we're not going to talk about other ones, which you could do that, but a lot of those, you notice, they only give you about 3 years of data, 5 years of data, which is good, but I like seeing 10 years of data for my companies, at least the ones that have 10 years of data, right? So I use quickfs.net, and let me just move my face a little bit so we can do some research here and go over some stocks. So one of my biggest long-term investments is Google, ticker symbol GOOG. And first and foremost, before we dive into some businesses here, what I personally do is I look for companies that have a growth trajectory for the most part, right? These companies that I invest in, the stocks, they have to have growth ahead of them. And yes, I do invest in businesses that don't have much growth, and we'll talk about those first. You know, like Pepsi, for example. Take a look at this. If I pop up Pepsi and I go down here, you guys can see this is 10 years of data. This is awesome. The revenue growth, if you look at my mouse here, you can see the revenue growth on Pepsi is not that impressive. In fact, it's in the single digits. Some years it doesn't even grow revenue. It goes down a bit. You can see here it's grown 1.2%, 1.8% in 2018, 4% 2019, 5% in 2020. That's a pretty good year for Pepsi. But you guys can see they don't have much growth. J&J, another one. J&J does not have much growth. It's in the single digit numbers. 3%, 6%, 6.7%, 1%, 1%. Look, the past 2 years, guys, well, look at this. Since 2018, J&J, 81 billion in revenue, right? That's what they did in 2018, and that's what they did in 2020. So they're not growing the top line, but they are still paying a dividend. The business is still good. So for the most part, when I look at businesses, yes, I do have some for cash flow, for dividends, and this is mostly for diversity, right? J&J, Pepsi, Mo is another one, Altria. If you guys know Altria, they have a pretty nice dividend. They pay a nice nice dividend, stable dividend in my opinion, but the top line, the revenue, it's not growing. I mean, look, they just did $20 billion in revenue in 2020, and they did almost $20 billion back in 2015. So the company hasn't grown much at all. Same with ExxonMobil, guys. I'm not sure if you know this, but ExxonMobil's top line is ridiculously wacky. Look at this. Back in 2011, they did about $400 billion in revenue. That is ridiculous. And now in 2020, they just did $200 billion. So it's gone down a ton. And this is one that over time it's gone down, but still they pay a nice dividend. It's not all about the top line when it comes to companies like XOM, Pepsi, more of the mature companies. And like I said, guys, I mostly focus on companies that have good growth. I'm talking 10-15% plus per year at least. That's what I look for when it comes to revenue, but I still like to have the Pepsis, the J&Js, the Altrias, the ExxonMobils, the Procter & Gambles, more for stability and for that dividend, and it's really more for stability, honestly, guys. So let's dive deeper into some of these statements. Google, number one. This is not Google. Let me pull up. This is ticker symbol G. GOOG is Google. And let me pull up the income statement first. And that's the beautiful thing about QuickFS.net. I don't pay a dime per month. I don't pay anything. This thing is free. And if you make an account, if you log in, you get all the income statements, the cash flow statements, the balance sheet, all that good stuff. And the income statement, if you guys didn't know, is also known as the profit and loss statement or the statement of revenue and expense. And the income statement primarily focuses on the company's revenue and expenses during a particular time period. And what we have right here again is Google. This is one of my favorite long-term companies to hold. It's one of my biggest long-term investments. And if we go back, actually, I went to the income statement a bit too early. Let's go back so I can show you guys the revenue growth of Google so you get an understanding of what I'm looking for here. Look, 30%, 21%, 13%. And this is back in 2011 to 2015. And you'd think, oh, Google's slowing down in revenue growth, right? Wrong. It's not. It's actually growing and accelerating in revenue. Look, 20%, 22%, 23%, 18%. In 2020, with the whole crisis, they grew 13%. So this is right in my range of 10-15% minimum growth, and that is why I like Google first and foremost. And if we look a little bit deeper under the hood, you guys can see gross profit is incredible. Out of that $182 billion they just made in 2020, minus the cost of goods sold of about $84 billion, gross profit is coming in at almost $100 billion, which is incredible. And what we have here is operating expenses. Mind you, gross profit, $100 billion. That does not include other expenses, operating expenses. So we have to take those out and add those up, right? And you can see as we move down the income statement, you can see a bunch of money ends up on the bottom line for Google. Net income came in at $40 billion. So they made $182 billion. Gross profit was $97 billion, minus the operating profit or operating expenses rather. We get an operating profit of $41 billion. You add net interest income, other non-operating income, we get $48 billion. And then of course, Uncle Sam, you know he wants his cut. They paid about $8 billion, a little bit under $8 billion in income tax with the net income of $40 billion. And look at how they've grown their bottom line over the past couple of years. Back in 2011, 10 years ago now, a decade ago, they did $10 billion in net income, and now they just did again $40 billion. So they 4x their net income over the past 10 years. That is incredible. I don't even know the compounded annual growth rate of that, but it's got to be what, 30% or 40? I don't even know off the top of my head, but that is incredible. So this is what I look at: income statement. I like to see how much money is going to the bottom line. Of course, we have the balance sheet as well. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time. And this is an awesome way to judge the health of a company. And let me make sure my face is not in the way. I hope I'm not blocking this stuff for you guys. Let me put myself up here. But overall, again, the balance sheet, it's like the health of a company. We can see here how much cash they have, cash and cash equivalents, how much money in short-term investments that they have. And short-term investments are investments that they can typically get that cash very quickly, right? They can liquidate that and put it on the cash and put it in cash and cash equivalents on the balance sheet. So, I mean, guys, Google is ridiculous. Just look at these numbers. They have $27 billion, about $26 billion in cash and cash equivalents, and $110 billion in short-term investments. You guys can see that right here. Accounts receivable, they have about $31 billion. That's money that they're going to get here soon. Inventories at about $728 million. So total current assets, Google has $175 billion. And if we add other investments, property, plant, and equipment, goodwill, intangible assets, and other assets, we get total assets of $300 billion. And total liabilities, you guys can see down here, those are about $97 billion, about $100 billion. And most of those, you guys can see, are total current liabilities. And the official accounting definition of current liabilities, they're often understood as all the liabilities of the business that are to be settled in cash within the fiscal year or the operating cycle of a given firm, whichever period is longer. So they have about $56 billion in current liabilities, and long-term debt they have about $13 billion, capital leases $11 billion, deferred revenue $4 billion. So overall, they have a lot more in assets, $320 billion in assets, than they have in total liabilities. And trust me, guys, if Google wanted to liquidate some of those short-term investments, which they can easily do, and convert that to cash, $110 billion worth, they could pay off all their liabilities literally like that in the snap of a finger, which is insane. So this goes to show how healthy of a business Google is. And this is what I like to look for. I don't want to see a company, right, that has a ton of liabilities and they're not growing revenue and they don't have much cash or cash equivalents. That would be a very unhealthy business, right? And what we have right here is the statement of cash flows. And out of all three of these financial statements, guys, I'll be honest, this is the one that I pay attention to the least, although I still look at it. Of course, you must analyze all this stuff, but I think the income statement and the balance sheet, those two are superior. That's just in my personal opinion. But again, you must always look at all of these, and the statement of cash flows is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. It also includes all cash outflows that pay for a business activities and investments during a given time period. And we can see here overall the cash from operations when it comes down to Google, ticker symbol GOG. Ever since 2011, it's gone from 14 billion, 18 billion, 37 billion, and now trailing 12 months in 2022, you guys can see that in 2020, you can see $65 billion in cash from operations, and you guys can see property, plant, and equipment, acquisitions, investments. That's what's listed here in cash from investing. You can see here the net issuance of common stock, net issuance of debt, cash from financing, and again, it pretty much just shows all the inflows, outflows when it comes to Google and all of the cash, hence why it's called the cash flow statement or the statement of cash flows, however you want to call it. So overall, guys, I mean, look, I like to see businesses growing over time, at least 10-15%, and if they pay a dividend, so be it. That's awesome. It's like the cherry on top, but I'm not really looking to invest in businesses solely because of the dividend, other than those more value stable companies we mentioned earlier. Other than those that do pay dividends, I'm not hunting for dividends if it makes any sense. You know, one of the companies I do own is MasterCard. They do pay a dividend, which is great, and they're still growing the business business very quickly. You guys can see if we look at their revenue growth, it's between anywhere from 10, 15, 20% on the good years. And of course, in 2020, they did go down a bit. They lost 10% when it comes to revenue. And a lot of businesses, especially the payment processors, guys, since the economy suffered and it's still suffering, they got hurt. So overall, guys, I don't want to make this video way too long, and of course, there's going to be a next part, and that's what I do. I mean, I like to look at the financial statements. I like to see overall those 3 checklist points hit from what we talked about in part 1, and again, that's linked right down below. And this is still, believe it or not, the beginning of the analysis process. You have to see a business that's great. Obviously, we covered all those points in part 1. You have to look at the financial stability of the business, how much money they're making, and so forth. And what's next is the hard part. Now you have to look at the stock's price, because value is what you get, price is what you pay, right? That's super important. Let me say that again. Value is what you get, which is pretty much a lot of what we covered today. The numbers, the financials. Value is what you get, but price is what you pay. And if the price is too high, even if the business is doing great, it might not be the best investment, right? So in the next couple of parts, which is why you must subscribe, we're going to go over how to value a company and determine whether or not it's undervalued, overvalued, if it's fair value, and we'll look at a couple of different metrics. We'll run some valuations. So yeah, make sure to subscribe for part 3. This was part 2. Part 1 is linked down below. Hope you guys enjoyed it. If you did, hit the like button, subscribe. Make sure to go down below, get into the Strive Smart Discord chat, check out my Patreon for buy and sell alerts, call outs, morning update videos, more access to me throughout the day and what I'm doing in my personal portfolios. And you could also get some free money from WeBull, 2 stocks down below. Also $30 from M1 Finance. That is limited time, so get your $30 from M1 Finance. All of those are linked down below. I'll catch you all in the next video. Thanks for watching. As always, peace out, guys.